Welcome to this new episode of Your Next Trade called today Credit Next. I'm Gregoire Dupont, I'm in sunny London, and as always, every weekend I want to go through what happened over the week and what we think is going to be happening in the next few weeks. So we had quite a sell-off in the equity market since mid-February, where the equity market are now down on the year in the US, as we're going to see for this week. We had bonds on Friday, so maybe this is the start of something more after a sell-off of 10% for the equity market for the S&P 500. If you look at history, over the last 60, 70 years, the S&P 500 will be very often coming down by 10%. So this is your average sell-off. And when I mean average sell-off, this is when you don't go into a recession. As we covered in the 4x4 video series, what we saw is over time, when you do have a recession, then you end up with a more severe drawdown. We are talking 30% on average. So if you think that the US economy will not go into recession, that is your normal correction. We are talking 10%. If you think, on the other hand, that we're going to have a recession, you should be calling for a 30 to 40 to 50% drawdown. So instead of having the equity market, the S&P going into the 5,500, then you are talking 45 to 4,000 on the S&P. But let's start with something really interesting, which is looking at this chart of the S&P 500, the performance that is in purple for the high yield market versus the stock. So if you've been growing as an equity trader, as a stock trader, you do know that most of the time you've been told that the equities, the stocks will be following credit. And what has been happening so far, there has been a divergence most recently between stocks and the high yield credit, where S&P has been coming down by 10%, but in the meantime, credit through the ETF has been barely moving. So for the time being, what is credit telling us is we don't have a recession. It's still fine. There is not much of higher spreads in the credit market. So, and if you look at history, most of the time, we have the Fed that will intervene when the credit market is in turmoil, not necessarily when stocks are coming down. So if you think about the Fed put, people are talking, do we have a Fed put in the equity market? When will the FOMC be doing something? I believe that this is far from being the case. You need to see actually this purple going much lower, meaning that the spreads, that there is tension, that there is views that the credit market, that most or more companies will be struggling to pay back their credit. So if we look now going into the year-to-date asset performance, as we can see, stocks in the US are down 8% for the Nasdaq and the Russell 4% for the S&P 500. The stock 600 Europe is doing very well. We are talking between 7 to 10%. Why? Because Germany has been announcing over the last couple of weeks that they will be doing a 500 billion fiscal stimulus kind of, building back its defense, and that's going to be for the next 10 years. Stocks really like the idea of having 1 to 2% GDP more in Europe. But having said that, as we're going to see, that means higher cost for the debt. And I think going forward, that will be an issue for Europe. If we look at the purple here, we have the weakening of the US dollar since the start of the year. Dollar is down 4 to 5% versus most currencies. The Trump administration does like it, actually, because that means we're going to see more exports coming from US companies. Cryptos through Bitcoin still down 10%. Gold very, very strong. So we reached above $3,000 for the gold. So far, gold has been a one-way ticket, very, very strong. As long as we are in a risk-off mode, Gold is doing very well. WTI down 6% for the year, trading between $65 and $70, and copper really, really strong. So what about the week-to-date asset performance? That's the same picture. We are down 2 to 3% for US markets, but I want to go immediately into the week-to-date industry performance because I think this is the most interesting picture of the week, obviously, where we do have the usual risk-off with metals and mining, silver, gold miners. But interestingly, as you can see, semiconductors have been doing well again versus the overall market. Why? Because NVIDIA was very, very strong over the week. So it's not the same story as before, where we had the sell-off of semiconductors. The momentum stocks were under pressure. This week, actually, momentum, the Momo stocks, were up 5% on the week. Friday was a very, very strong day. So who have been the losers? We are talking airlines, we are talking retail, transportation, online retail, consumer discretionary. What does it tell you? The market is scared about how the US consumer will be doing going forward, and that means there is risk on stagflation, and we could see really the US economy into a recession. So this is what the equity market is pricing. Again, look at those names, home builders. This is really about the cycle and the risk about the cycle. So if I look at the sector performance now, as we can see for the week, utilities have been doing pretty well, energy as well, consumer staples, so the defensive one have been struggling, same as consumer discretionary because, Tesla is still under pressure. So what about the rates now? Looking at the US 10 years, we are trading around 4.3%. So it's roughly, the trading range is between 4.2 to 4.7%. So on one hand, Trump administration would like lower yields, so we went from the 4.7% into the 4.2%. But in the meantime, we do know that there is more and more credit paper coming into the market, which is crowding out the overall market. When you do have a lot of supply coming into the market, you are asking for from investors higher yields, and this is what is happening. And in the meantime, the most important one is obviously the German 10 years, Italy 10 years, Japan 10 years, where due to the German bazooka, we have higher yields in Europe, and that is moving most of the credit market, yields market over the world. And I think, as I said, going forward, if you have been asking Europe to be paying 40 to 50 bips, 0.5% roughly more than it was a couple of months ago, and you don't see growth. Maybe it's going to be a bit of growth for Germany, but what about France? What about Spain? What about Italy? That means on one end you pay 0.5% more, but you don't have that much growth. So there's going to be a mismatch between this cost and actually how the overall economy is doing. What about the Fed fund rates? Important because we do have the FOMC meeting on Wednesday. So for this Wednesday meeting, the Fed is expected to do nothing, no move. Going forward, if you look until December here, we're expecting roughly 2.5 cuts going into the year. But as you can see, we move massively. So we are expecting, since the start of the year, a much more accommodative Fed than it was a couple of months ago. What about volatility? VIX now at 22% and below. We went into very high level. We went into 27%. Very high level. When I say that, you need to be careful because volatility could always go much, much higher. But that means in terms of structuring the trade, it's much harder to look at for downside when you do have volatility at 25% and above. So now I would like to move into our technical analysis, starting with, as always, the S&P. So this is a chart. So this is for your futures. I think the trend has been broken. So is it just for a few days and a bit of a bear trap? That could be the case. As I told you last weekend, I closed most of my shorts that was put spreads on the S&P. I did the same with the Euro stocks because I think there is a good seasonality for the next 2 weeks. If you look at the chart of the Nasdaq, it doesn't look that great. Again, we broke on the downside. So here you see this channel has been broken. But as always with the flows, you can see the RSI is pretty extreme. But we have a big week with the FOMC meeting. We do have option expiry on Friday. So you don't want a short to be a one-off and a bit of a bear trap. So you need a bit more confirmation going forward. I'm interested as well into the euro dollar. So we are now back into the 109. I don't know if you remember, but everyone was bearish when it was at 105 and below. So we came back in actually the range that we had for 2 years. Why? Because again, with this German bazooka, the view is that Europe is going to be doing better. I want to flag just one stock, which is Accenture, ACN in the US. That is a stock that we have been talking again on the Discord community on the most advanced channels, because our views is the following. We think that this is a good sell due to the DOGE and the fact that a lot of cuts will be happening from the overall US government. So the timing has been pretty hard. Most recently, we have seen a decent sell-off. Those are the names that really we are keeping an eye on because I think this is a space that is really interesting as a short. So don't want to spend too much time on technical analysis. I want to go back into what happened for the week. And I want to start with, instead of doing the S&P futures, I want to do the S&P 500 over the last 5 sessions. And what you see here is the red line. What is this red line? Is the 55.65 level, which is coming from the JP Morgan collar. So if you don't know, there is a huge fund that is having long position, and in the meantime is hedging all of those positions with a column. What is a column? Is we are talking 3 positions, and they are here. And I explained to you how it works. So you do have like a put options, you do have like another put options, and you have a call. So you'll be, if you are this JP Morgan fund, which is this one, you do have like this put option that is expiring at the end of March, which is the 55.65. So you long this one, you short this put at 4,700, and you short this call. So in other words, you'll be collecting some of the premium because you're thinking that it's not going to be moving that much of those two levels, 2 strikes, and in the meantime you are taking some protection. So what is happening is, as you can see, the size of this position here, we are talking roughly 36,000 calls and puts. The market, when it is moving big time, does have a tendency to move into those big strikes. And as you can see, this 55.65, which is the expiry for the end of March, but you should be taking not for the future, but for the cash. As you can see, this is where we have been hovering most recently. So there is a chance that actually the market in the next few weeks will be trending around this 55.65, but as you can see, we have been bouncing nicely around this level. So as always, you need to understand the market structure, what have been the big positioning, and obviously the market has been moving from the cash into options, and this collar from the JP Morgan is very important. If we look at what has been happening as well in terms of macro, we had the CPI, we had the PPI. So CPI came a bit lower than expected, which was good news. And as you can see, this is something, again, we explained in the 4x4. There is no magic. The Fed fund rates, the Fed targets are very much in line with where is the CPI trending, and we are talking the core CPI. So for the week, we had the core CPI, we had the bond supplies, we had the tariff headlines, as I said, the JP Morgan, and finally the German bazooka. On Friday, as we see here, there has been a big move, so a kind of a rally after the sell-off that we had over the last month or so, which mostly was driven by 0 day to expiry, a lot of momentum stocks that did very well, as well. Space that we are looking at, which is Quantum. Quantum did very, very well on Friday. So those names have been pushed, which tells us that actually retail is not totally dead. What happened over the last months? First, it was the retail that suffered, but then we had a massive degrossing of hedge funds. So if you are a hedge fund, you are not having, if let's say you get 10 million or 100 million under management, it's not like the average trader in the US, you're not going to have 1 to 2 times exposure. Actually, what you're going to be running, it's 5, 10, 15 times exposure. So your gross exposure, which is your long and your short, if you get 100 million under management, when I was working for a hedge fund, literally we will be running 500% gross exposure, while your long could be 250% and your short could be 250%. But when everything goes against you, you need to deleverage. So instead of having 500%, you go to 400 to 300. Not only because you get bad performance, because your prime broker, meaning the bank that is lending you money to do this leverage, is telling you to reduce your leverage. So this is what has been happening for most hedge funds most recently, and the names, what we call the VIP, the big names that were where we are talking fabulous 7 for most hedge funds, actually they had to sell those positions. So if you look at the performance of most of those hedge funds, we are talking Citadel, we are talking Millennium, over the last months they suffered quite a lot and their performances have been pretty bad. So now that the degrossing has been happening, actually there is space for a kind of a relief rally. So what about the catalyst going forward? We do have like the retail sales on Monday. Why is it so important? Because when we started this call, we said credit market is saying it's pretty much okay. We do have like questions about, are we into a stagflation? And obviously retail sales is very important, that it's making, US consumer is making 80% of the GDP. So let's see on Monday how the retail sales have been doing. We do have on Wednesday the FOMC rate decision. We should expect a no move from the FOMC. Why? Because I think it's pretty much too early. And as I said, as long as the credit market is doing fine, there are not going to be any intervention. What about, so retail sales, FOMC, we do have like option expiry and index rebalancing. So we had a massive move since last expiry, which was in December. So we had a big move up in January, then down in February and March. And as always, when you have so much divergence and moves over 3 months, you should expect a big option expiry. A lot of volume on Friday, a lot of moves, but as well, you're going to have the index rebalancing. So you have some names going, for example, into the S&P 500 and some exiting the S&P 500. I want to flag again this S&P 500 seasonality. So we are sitting literally here because it's over the weekend, 14 to 15 of March. But as you can see, there is a bit of good seasonality for the rest of the month. So this is really something that we've been flagging. The first 2 weeks have been of a struggle. Now, in terms of seasonality, there is good seasonality. Coming back into the FOMC meeting, we could expect some volatility on the day, not only on the decision, but what the FOMC, the Fed, Powell will be saying after the call. Finally, we do have like earnings. As I said, Accenture, we get FedEx. The big meeting is NVIDIA Jensen on Tuesday, talking at 1 p.m. Eastern time. So everyone will be looking at it. So this is roughly what we have for the week. Volatility, expected volatility through a 1 week straddle for the S&P is coming down a bit at 2.4%, plus or minus 2.4%. Last week it was plus minus 2.6%. And actually we finished around this level, but in the meantime we moved by 4%. So let's see if realized volatility could go and come lower than implied volatility. So this is it for me for this week. If you want to know more about the 4x4 video series, about the mentoring, where we do one-on-one sessions through Zoom, so it's 12 sessions, send me an email. You can reach me on Discord as well, on social media, or you can join us on the trading community. We get more than I think 800 traders now. We are talking 100 traders more than I'm pretty active that will be here every single day to look for good ideas and sharing ideas. So this is it for me for this week. Have a good trading week. Bye-bye.